com.au. And joining me on the panel tonight, we're very lucky to have John Athanasiou from Redleaf Securities and also David Buckland from Montgomery Investment Management. Well, we've seen the market rising this week. It's a good sign, and I guess a lot of people are asking, well, is this the end of the volatility that we've seen in August and September? This quarter, we do see a record amount of dividends being paid, over $20 billion. Is that going to be enough to support us to a Santa rally? Let's ask both our panellists. I mean, David, looking at the market, it's quite exciting to see good performances 2 days in a row. And I guess the question is, well, what are you doing in this type of environment? Are you buying up big? Are you still a little cautious?
Yeah, at Montgomery Investment Management, Julia, we're still a little cautious. So in simple terms, the market just about got to 6,000 points in very early March. It fell 1,000 points between early March and very, very late September. Got down to just a little over 5,000 points. And what it's done, it's rallied from a bit below 5,000 to roughly 5,200 points. So we've had 4 or 5 quite nice days, but the context is those 4 or 5 quite nice days are on the back of a 1,000-point fall. So we shouldn't get overly excited, but definitely it's nice to see a little bit of black rather than a lot of red. Let's not forget, a lot of that red was the result of a pretty rough reporting season. Not just the reporting season, but more the outlook from a lot of the companies. That was a fairly sober outlook from a lot of the companies, and more importantly, from Australia's point of view, commodity prices hitting multi-year lows on the back of the China slowdown.
Okay, so given that the earnings story is not looking to crash hot here in Australia, and certainly not in the US either, where earnings growth looks like it's peaked, and longer-term share prices tend to follow earnings, are you less positive about the Australian market?
What we've done at Montgomery is we've really selectively just spent a little bit of cash opportunistically. So, for example, Quadrant, who are a private equity firm, owned 18% of a business called Isentia. And some weeks ago, they divested that entire holding, exited it in its entirety. The stock fell back towards about $3.20. It had been trading at $3.50, $3.60. So we picked up a really nice holding at around $3.25. It's since rallied to $4. So we've been selective buyers of 2 or 3, I'll call them quite very high quality industrial companies during this period of severe weakness.
Given that the bank's yields are looking so attractive compared to the cash rate, David, is that something that you'd support, even though there are some pressures on earnings at the moment and in terms of capital?
Look, I think it's a very difficult one to call. It's very difficult because the banks 25 years ago, 2/3 of their loan book were to businesses and 1/3 were the household sector, and that over the last 2 and a bit decades has completely reversed. So it's now 2/3 are to the household sector and 1/3 to banks. And we know one thing about the household sector. Number one is they're highly indebted. Number two is that houses, as a value of debt and income, are off the Richter scale on the eastern seaboard of Australia. And so by definition, the banks have a lot of exposure to the households who are highly indebted and to housing. So if housing either comes off the boil, which I think is a fairly reasonable probability over the medium term, or unemployment goes up, which I also think is a bit of a chance, then I think banks' long-term provision for bad and doubtful debts probably will rise. And if that is the case, it'll put pressure on their earnings. So all I'm saying is that's something to consider for people that just go blindly and say, yield of 6.5%, it's a lay-down misère. It may be, but it may not be.
Okay, so the yield's certainly looking attractive, but the earnings not so much. And I guess it's a question, you know, a lot of these people have been in the bank since they first floated CBA at $5.40, and, you know, they're never going to get out.
No, look, they're a brilliant yielding asset at this point in time. But I'm just saying to our viewers, we should be a little bit aware that on occasions, typically 2 years in 10 or 2 years in 15, the bank's earnings do come under a bit of pressure.
Relatively well. I mean, David, when you look at investments like this, what do you think?
Well, first thing, we don't look at
speculative.
Yeah, we don't look at things like this because what we're focused on is businesses that make profit, and sustainably so. I'm not saying Magnus won't one day, but I'm just simply saying that until it can get the commodity out of the ground, profitably, get it to port and get it to the customers and make money on it. For my money, it is sheer speculation. So, look, that's fine for some investors, but not for an organisation like Montgomery.
Okay, sure. So information technology, very small space in Australia, but this is a stock price chart that you want all your stocks to look like. This is what Hansen looks like at the moment. It just is, I guess it's got support at $3 and looking to potentially break out there. Looking in this IT space, is Hansen one that you like, David?
Look, it's a very well-run business. Andrew Hansen's been running it since the business was effectively listed, which must be now, I'm thinking about 15 years ago, and they actually made a few poor acquisitions early in their corporate life, and in fact had to have a very significant capital raising, believe it or not, at about 13 cents. So they have travelled from some distance from 13 cents of several years ago. So what they've done now is they've got a very, very strong recurring earnings stream. I think about 70% of their earnings is recurring. But what they have is they have many contracts in the billing space for telecommunications, gas, water, electricity. And they get a strong recurring earnings stream out of that. But the issue I have with it is that they're often quite small value contracts. So this one has been a bit of a game of inches. It's taken a long time for the market to appreciate how well the organisation's done. But I don't think you're going to get a sort of like a factor gain out of it. For our money at Montgomery, it's probably a little on the expensive side, but we very much like the management and the organisation.
Okay, so we'll go to our next caller. We've got Vincent on the line from Melbourne. Vincent, welcome. What's your question tonight?
Yes, good evening. I had a question on the stock Infomedia. I'm a long-term holder of that. I believe Montgomery Investment has also been a holder and backer of the stock. The stock is down 40% in the last few months amid the sacking of the CEO and a nasty boardroom challenge from the ex-CEO. I'd just like to ask David his thoughts on where the stock is going and his thoughts on the management.
Sure.
Thank you.
So this is Infomedia. IFM's the stock code. Unfortunately, share price hasn't been doing so well. David, maybe you could tell us a little bit about the company and what's been happening in its boardroom and how it's been impacting on the outlook for the company.
Well, as Vincent said, it's come down from about $1.20 to sort of 70 odd cents. It's missed its earnings guidance a couple of times, and that usually in corporate Australia is sort of a bit of a death knell for the CEO. The CEO has recently resigned, and what has happened is the former CEO, who was on the board till November last year, who was also, I guess, the founder of the business and one of the great strengths behind the business's strategy, has now sort of tried to throw his oar into the water to some degree and get involved. The incumbent board is rejecting his overtures and sort of trying to call for a bit of a clean slate. And I guess with any of these situations, the share price has reacted negatively to that associated uncertainty. Our view is that it's a good underlying business that, if well managed, we'll look back and say this is a bit of an opportunity. But there's still a lot of water to flow under the bridge in terms of a new CEO, who that person will be, whether the board does settle down, and whether the big company does become well managed. Now, as I say, historically it's been a strong business, and we think it can return to that strength at some stage, but certainly not in the very, very immediate term. So, buying it here in the low 70s, you're definitely putting your hand on your heart and hoping that the board gets the right CEO and things do settle.
And David, I mean, it is an interesting business. It's all about car parts, and they have sort of not only a catalogue but also a selling system around that, and data analysis, information research for the automotive industry.
Look, it's got a very high return on equity. It's got a very, very reasonably strong balance sheet, and up until missing its earnings guidance, as I say, on two occasions, I think it probably was one of those small caps. It's only capitalised at about 225 million Australian dollars, but it was one of those small caps that I think people sort of said, I wonder if it'll go to the next level. And I guess that's one thing we've been wondering: will it go to the next level? And we're prepared to give it a bit of time.
Okay, so would you be accumulating more?
Yeah, I think, look, it's any time there's a lot of uncertainty, there's risk, and that's why the share price is weak. There is risk. And I think what happens is, as investors, you've got to make a decision: is this structurally flawed, or is it just temporary? And you don't really know. You're making the best educated guess you can, and our view is it's probably temporary rather than a structural flaw.
Okay.
It wasn't me, but Walmart's a very interesting organisation. I think their revenue line exceeds $1 billion a day, US. So I think they're something like 6 to 8 times the size of Woolworths. But John's absolutely right. When you end up supplying an organisation like Walmart, you think you've won the lottery. But often you've got to really be careful, because what happens is that any supplier, and I do know one that was a major supplier in a particular item, they thought they won the lottery, and over a period of about 10 years, their margins just got slowly crushed by Walmart. Walmart have all the power ultimately, and unless you're producing something unbelievably special, they just slowly ratchet around the margin. So, you know, all I say is it does sound very, very exciting, but just be a little careful.
As well. So, looking at Blackham, what do you think, David?
Well, I can't make any comment, John, on Blackham Resources, but what I can say is that what has in fact happened is that the gold sector did go through a bit of a hell when the gold price fell dramatically from approximately $1,700 an ounce to approximately $1,100 an ounce. And what happened was a lot of the gold companies really battened down the hatches, got their cost base down really aggressively. And then we saw the decline of the Australian dollar over the last few years from well above parity to approximately 70 cents. So what's actually happened is that their margins on their costs versus the revenue have actually expanded quite nicely, and that's produced a lot more free cash flow for a lot of these producing companies. And I think one classic example is Evolution Mining, where we saw that the margin suddenly increased, by $100 to $150 an ounce in terms of free cash flow, simply because of the currency.
Okay, so I think a rather difficult question coming through from Richard, because there's two parts of that question. One's around the dividend yield, which obviously is very attractive, and the second part around capital preservation, which of course is a big question mark around. So if you don't like the banks in that sort of context, well, what are some alternative investments possibly out there? So, David?
Well, just to answer Richard's question, yes, they are yielding 6 to 6.5%. But the risk you're taking in acquiring that 6.5% yield is possibly decline in your capital. So I think since April, Julia, on average, the banks for a few months there declined by about 25%. So, you need to buy them well to make sure that you're just not peeling off a lot of your capital. As I say, declines of 20–25% across the four majors in, I think it was about a 4-month period, is relatively on the frightening side. The issue I have with the banking sector generally is that they've had this extremely good tailwind for decades in general terms, and that tailwind is starting to become a little bit of a headwind in terms of the regulatory requirements based on the capital, and also on a global basis based on Basel IV. They definitely need more capital, and they are very influenced by housing and confidence around housing and confidence around unemployment. So I just make the point that if unemployment goes up or housing falls or a combination of both, the banks may have to provision more aggressively for bad and doubtful debts, which they are relatively low in terms of their provisioning at present. And I just make that point that you've just got to be a tiny bit cautious about that prospect.
But other ideas in this space, David?
I think, Richard, it's the best idea is to focus on really strong businesses whose earnings are growing solidly over the medium to longer term, and the dividends will follow. And interestingly enough, you might buy something on a relatively low yield today, but if it's a great industrial company with great earnings growth, you'll look back 5–10 years previous and say, gee, what a beautiful yield on the price I acquired it at. And I keep pointing to M2 Telecommunications, which 10 years ago was 30-something cents and paid out about 1.5 cents in dividends, and today it pays out over 30 cents in dividends. So based on the price 10 years ago, you're now getting a yield of 100%. You know, whereas Telstra 10 years ago, its dividends were roughly where they are today.
Yeah.
So buy high-quality industrial businesses whose earnings are growing solidly, and the dividends will look after themselves.
Okay, so really good point there. And I guess we were talking about the banks, and, you know, David, a lot of us don't remember the last recession in Australia in the early 1990s, but I believe back then there was talk of, you know, banks having real difficulty and perhaps not even lasting that recession.
Well, there was probably two of the banks were probably technically insolvent, and they had to have massive capital raisings. And this was where highly unusual circumstances. This was the recession we had to have. Commercial property in Sydney and Melbourne effectively halved.
Interest rates, double digit.
Very high interest rates, and they had finance companies that had lent very, very aggressively on property at around the top of the cycle. So what can happen is that they can get bashed up. They're actually highly leveraged businesses to falling property prices, as a simple example. So you've just got to be a little careful. It's not just one-way traffic.
Okay, so then it says a historical dividend yield of 8.2%, and that would suggest that the market doesn't believe that that dividend's going to be continuing at that level. David, what
I think with roll-ups, Julia, they work until they stop working. And what happened with G8 was they made a lot of acquisitions, and they were very strict about the multiple they paid. And suddenly they broke ranks and bought a lot of centres for a multiple that was significantly higher than their stated maximum. What then transpires is you tend to see with roll-ups a little bit of a fairly aggressive accounting, and the cash flows aren't often the same as the profits of the businesses they're acquiring. So we've been a little on the cautious side of this one, and we certainly haven't owned it for quite a long period of time. The second point to make is with roll-ups, you've got to be a little careful, because if they're paying, for example, an EBIT multiple of 4 times consistently, why, just because it's a publicly listed company, do you as shareholders pay 8 times or 9 times or 10 times when you theoretically could also go and pay 4 times, in theory? So you just got to be a little careful about paying double the multiple that they're paying and just giving them a free kick.
Okay, so are you generally against the roll-up model?
No, what I'm saying with the roll-up model is that often with roll-up models, particularly around people, is that you've also got to get the culture right. And sometimes when you're rolling up on the people side, it's too easy to for the vendors to say, I'll take the money and run, and I don't really like these new acquirers. And suddenly the acquirer doesn't quite know what they've bought. So you've got to be a bit careful on that front. But the more importantly, from my point of view, is why do we as shareholders pay twice what they're acquiring the underlying investment at? So we'll talk about it later, but it's a bit like an LIC. If the LIC's got an NTA of $1, why would we pay $1.50 for an NTA of $1? You know, it's just sort of a bit of a mathematical logic at times.
I mean, David, you don't sound impressed by LICs at all.
What I think, Julia, and this is particularly for Pauline and other viewers, is that usually a few years every cycle they sell at a really good discount to what we call their net tangible asset backing. So if their net tangible asset backing is $1 and they sell at, say, 80 cents, then you're buying them at a very good discount, then it's worth having a look at. But to me, if their net tangible asset backing is $1 and they're selling for $1.20, I just think it's a mathematical logic to buy them. I just go and rather buy the $1 worth of shares. Yep. So I think you buy them at a discount, sell them at a big premium. The other thing I should point out is that the older LICs, the ones that have been around for decades, such as Argo, which John mentioned, and Djerriwarrh and AFIC, their fee structure is very, very, very low. But those LICs that have been listed in the last 10 years, generally, their fee structure is quite high. So my preference generally is to buy the older ones because of their much lower fee structure, and buy them those few periods every decade when they sell at a big discount to their net tangible asset backing, i.e. the 80 cents in the dollar, the 85 cents in the dollar, rather than the $1.20 in the dollar. Okay,
so always buying a discount. I think that's what John was saying as well, and some ideas there. David, preferring the older ones like Argo as well as
AFIC and Djerriwarrh. They're just their fee structure is very low compared with the more modern LICs.
Quite popular. But David, at these levels, would you be buying in?
Well, we like it. We're a shareholder in it. We've owned it for quite a period of time, and we've got a sort of valuation on it closer to $5.50, Michael. It ticks a lot of boxes. It's got a very high return on equity. It's got an excellent balance sheet, and it's got very good growth prospects. And it's selling for less than our assessment of its valuation. So for us, we like it. But I'd have to say, not that long ago, it was $2.50. So the easy fruit's definitely been picked. And so unless we get a lot of new information, I would say that a large amount of the gain is now behind us. And it's less easy. Now, back to your question about 200-point moves. Look, at 5,000 points or 5,200 points, a 200-point move is a 4% move. And 4% moves up and down can be just pinned down to randomness. It can be sentiment, it can be what's happening to interest rates, it can be I'm feeling less bad about things. And one thing I should point out is that there's a lot of global mining houses that have fallen 80 or 90%. So they've gone from 100 down to 20, and they bounce from 20 to 30, and everyone goes, oh, they're up 50%. But what you've got to realise is they're still down 70 from their peak, even though they're up 50. So these things, when they get so low, they can rally very dramatically from 100 down to 20 and back to 30. And suddenly everyone feels good because they've rallied 50%. They're still down 70% in total. So I wouldn't get too worked up about a 200-point move one way or the other. What I'd get worked up about is whether these trends are sustainable over a period of a year or two or three, not, a period of a week.
Look at it. David, how about you?
Well, with anything that's sort of agriculturally based, I think you've got to work out whether it's adding value or not. And you look at the return on equity, which is simply the profitability of the company divided by its equity, and you also make sure it's not got too much debt. But to me, that's a bit more of a commodity-driven company, as distinct, we were talking about at Bellamy's earlier, where there's a lot of value add that's occurring. Back to telecommunications, I would prefer something like the M2 Vocus merger that's been proposed over Telstra, because to me, that business is going to have a lot of growth over the medium to longer term, whereas Telstra, its earnings today aren't greatly different to where they were 10 or 12 years ago.
Okay.